Ever wondered how credit card interest works in the UK? Well, you're not alone. It's a topic many find confusing, yet it's incredibly relevant to anyone who uses a credit card. Understanding how this interest works could potentially save you a significant amount of money and help you steer clear of unwanted debt. But worry not, we're here to clear the fog. So buckle up as we journey into the world of credit card interest. Stay tuned as we demystify the concept of credit card interest. You may ask, what exactly is credit card interest? Well, let's unravel this together. Credit card interest, also known as the annual percentage rate or APR, is essentially a fee charged by your credit card company for the privilege of borrowing money. Imagine it as a rental fee, but instead of renting a house or a car, you're renting money. Sounds intriguing, right? Now here's an important point to remember. Not all transactions are created equal. The interest charged can vary based on the type of transaction you make with your credit card. There are three main types to consider: purchases, cash advances, and balance transfers. Firstly, purchases. These are your everyday transactions like buying a coffee or a new pair of shoes. The interest rate for purchases is usually the one advertised by the credit card company, and it's what most people think of when they talk about credit card interest. Next, we have cash advances. This is when you use your credit card to withdraw cash, perhaps from an ATM. Cash advances often come with a higher interest rate than purchases. Why? Because credit card companies view them as riskier. After all, if you're regularly withdrawing cash on your credit card, that might signal you're struggling to manage your finances. Lastly, there's balance transfers. This is when you move debt from one credit card to another, often to take advantage of a lower interest rate. The interest rate for balance transfers can vary widely, sometimes being lower than the rate for purchases, sometimes higher. It all depends on the terms of your credit card agreement. So there you have it. Credit card interest is a charge levied for borrowing money, and it can vary depending on the type of transaction. It's a crucial part of understanding how credit cards work, and knowing the ins and outs can help you make smarter financial decisions. Now that you know what credit card interest is, let's delve into how it's calculated. Calculating credit card interest may seem daunting, but it's simpler than you think. Let's break it down. First, we need to understand the term annual percentage rate, or APR. This is the yearly interest rate charged on your credit card balance. It's important to note that different types of transactions like purchases, cash advances, and balance transfers may have different APRs. Now, credit card companies usually calculate interest on a daily or monthly basis. So the APR needs to be converted accordingly. To get the daily rate, divide the APR by 365. For the monthly rate, divide it by 12. Let's walk through an example. Imagine you have a credit card with an APR of 20%. To find the daily rate, we divide 20 by 365, which gives us approximately 0.055% per day. To get the monthly rate, we divide 20 by 12, which equals about 1.67% per month. Now, how does this apply to your credit card balance? Say your balance is £1,000. If your credit card company calculates interest daily, they'll multiply your daily balance by the daily rate. So, 0.055% of £1,000 is approximately 55 pence. This amount is added to your balance each day, and the next day's interest is calculated on this new balance. If your credit card company calculates interest monthly, they'll multiply your average daily balance for the month by the monthly rate. So, 1.67% of £1,000 is approximately £16.70. This amount is added to your balance at the end of the month. So, you see, understanding how credit card interest is calculated isn't as complex as it may initially appear. It's merely a matter of understanding the APR and how it's applied to your balance. Understanding how your interest is calculated empowers you to make more informed financial decisions. Now comes the million-dollar question. How can you minimize credit card interest? Credit card interest can often feel like a heavy chain around your financial freedom. But with the right strategies, you can minimize this cost and make your credit card work for you. Firstly, One of the most effective ways to keep interest at bay is to pay off your credit card balance in full each month. By doing this, you're essentially using your credit card as a short-term loan. You borrow money when you make a purchase, but then you pay it back in full before any interest is charged. It's like getting a free ride, as long as you remember to pay on time. Secondly, consider taking advantage of 0% annual percentage rate, or APR, offers. Many credit cards offer a promotional period where you won't be charged any interest on your purchases. This can be an excellent way to finance a large purchase without incurring any interest. However, be careful to read the fine print. When the promotional period ends, the interest rate can skyrocket, so make sure you can pay off the balance before then. Lastly, if you tend to carry a balance on your credit card, look for cards with lower interest rates. While it's not as good as paying off your balance in full each month, a lower interest rate can save you a significant amount of money over time. And remember, you're not stuck with your current card. If you have a good credit score, you can shop around for a card with a better rate. To recap, minimizing credit card interest can be as simple as paying off your balance in full each month, taking advantage of 0% APR offers, and looking for cards with lower interest rates. It may require some discipline and careful planning, but the savings can be worth it. With these strategies, you can keep your credit card interest to a minimum. There are some common misconceptions about credit card interest that we need to clear up. Firstly, a prevalent misunderstanding is that everyone is charged the same interest rate. This is not true. The annual percentage rate, or APR, varies greatly from one card to another, and even from one customer to another. Factors such as your credit score, income, and payment history can all influence the interest rate that you're offered. So it's always wise to shop around and compare rates before committing to a card. Another common myth is that you're only charged interest if you miss a payment. While it's true that late payments can result in additional fees and higher interest rates, interest is actually calculated based on your average daily balance. This means if you're carrying a balance on your card, you're accruing interest every day, even if you make all your payments on time. There's also a misconception that paying the minimum due each month means you won't be charged interest. In reality, when you only make the minimum payment, you're just barely covering the interest, and the bulk of your balance remains unpaid. So, you're still accruing interest on that remaining balance. Moreover, some people believe that credit card interest is tax deductible. While this can be true for some types of interest, such as mortgage interest, it's usually not the case for credit card interest. Lastly, there's a belief that transferring balances to a card with a lower interest rate will always save you money. While this can be true, it's important to consider balance transfer fees and any introductory rates that might increase after a certain period. Busting these myths helps you better understand how credit card interest works. So remember to always read the fine print, ask questions, and make informed decisions about your credit card usage. We've covered a lot about credit card interest today. We dived into what it is, how it's calculated, and how you can minimize it. We also debunked some common misconceptions. Let's recap. Credit card interest is the cost you pay for borrowing money. It's calculated using the APR, or annual percentage rate, and your average daily balance. It's not a one-time fee, but something you're charged every month you carry a balance. There are ways to minimize this interest. Paying your bill in full each month, or at least making more than the minimum payment, can drastically reduce the amount of interest you're charged. A lower APR, or a balance transfer to a card with a lower interest rate, can also help. We also cleared up some common misconceptions. Remember, credit card interest isn't a penalty or a static number. It's a cost of borrowing that can change based on your actions. And it's not something you're stuck with forever. You have the power to reduce or even eliminate it. Understanding credit card interest is crucial to your financial health. It helps you make informed decisions about your spending and borrowing. It's not just about the here and now, but about securing a more financially stable future. Remember, the more you know about credit card interest, the better financial decisions you can make. Thanks for watching.